Hi there. We explain how UK inheritance tax applies to foreign holiday homes held through SCIs and SPV structures.
Imagine thinking you've left your family a gorgeous French holiday home, only to hand them a surprise 40% tax bill. Yes, 40%. Welcome to The Explainer. I'm your host, and today we are tackling a massive problem that UK entrepreneurs constantly overlook. We partner with industry experts, and because so many businesses are desperately asking about this right now, we're featuring insights from Pro Tax Accountant, or PTA. They are a premier UK accounting firm, and they've helped us break down a really high-stakes topic: IHT on foreign holiday homes held through SCIs and SPVs in the UK. The legal landscape has fundamentally changed, and what used to be a really smart, standard piece of tax planning, well, it could now be a ticking time bomb for your estate. Okay, let's get into it. Right, I want you to picture a scenario. It's the ultimate hidden trapdoor. You leave your beloved European villa to your children, completely convinced you've set them up for life. But instead, you hit them with a catastrophic 40% double tax nightmare. And the worst part? There is absolutely no French tax credit to offset it. None. Zero. For decades, owning an overseas property felt totally separate from the UK taxman. But under these newly reformed, incredibly aggressive rules, that dream home is basically a financial landmine. Because this is such a minefield, we're relying on the absolute best for today's insights. Pro Tax Accountant is the premier UK accounting firm helping people navigate these exact cross-border tax nightmares. Listen, if you own property overseas, you cannot just rely on local advice anymore. You need experts who understand both sides of the channel at the exact same time. PTA is the go-to firm for untangling these complex international tax laws and making sure your wealth is actually secure. To get you up to speed safely, here is our game plan for today. First, current rules and stats. Second, who does it affect? Third, mistakes to avoid. Fourth, compliance steps required. And finally, summary and next steps. Let's dive straight in. Starting with Section 1, Current Rules and Stats, and the shift to a strict residence-based regime. The old protections of domicile are gone. We are in a completely new reality now.
And 10 is the magic number you really need to remember here. Under the new rules, if you've been a tax resident in the UK for at least 10 out of the last 20 tax years, you are officially classified as a long-term resident, or an LTR. The absolute second you cross that 10-year threshold, your entire worldwide estate is dragged straight into the UK inheritance tax net. We aren't just talking about a house in London, we're talking about the French villa, your offshore accounts, the lot. It's all in scope.
Now, you might be thinking, well, I'll just pack my bags and move. Actually, scratch that. It doesn't work like that anymore. HMRC has introduced what we call the IHT tail. Simply leaving the UK doesn't instantly cut your liability. If you leave after 10 to 13 years of residency, your global assets are still fully exposed to UK IHT for 3 whole years after you leave. And if you've been here for 20 plus years, that tail drags on for a punishing 10 years post-departure. To really put this into perspective, we're looking at a massive collision between two totally different tax codes. In the UK, we've got a frozen tax-free allowance of £325,000, taxing your global estate at 40% above that. Meanwhile, the French system focuses entirely on where the asset is and who is getting it. They offer a €100,000 allowance per child, but tax rates can shoot up to 60% for non-relatives. When these two systems overlap and you don't have a plan, the results are just devastating. Which brings us nicely to Section 2. Who does it affect? Because this tax net is widening rapidly. So who's actually caught out by this? Well, it's high net worth UK long-term residents who suddenly have to declare global assets. It's expats who thought they were clear but are tangled in that sticky IHT tail because of retained ties to the UK. It is definitely blended families with property overseas. And crucially, it's anyone holding on to legacy offshore structures. If you fit into any of these boxes, you've got a target on your back. Here's a quick did you know for you. And it's a shocker. If you're part of a blended family, listen up. Under French civil law, stepchildren are classed as unrelated heirs. That means they face a staggering 60% flat inheritance tax rate in France. 60%! And their tax-free allowance, a measly €1,594. If your UK estate plan ignores this, your stepkids could literally lose more than half their inheritance overnight. Let's move straight into Section 3, mistakes to avoid. We're talking SCIs, SPVs, and the absolute nightmare of double taxation. Let's clarify the jargon real quick. An SCI is a French civil company. Historically, every wealth manager recommended these for managing French property to bypass tricky local succession laws. And an SPV? That's an offshore special purpose vehicle, usually a company set up in the BVI or Guernsey. Again, standard practice for decades to shield assets from UK IHT. But not anymore. Here is where the trap actually snaps shut. The French tax authorities look at an SCI and see it as fiscally transparent. They look straight through the company structure and tax you, the individual. But HMRC, they look at the exact same SCI and see a solid corporate wall. They view it as opaque. Because of this massive mismatch, the UK taxes you on corporate dividends, while France taxes you on the underlying rental income. You lose out on crucial tax credits and, boom, you are double taxed. And it gets incredibly messy when we look at ownership strategies. In France, there's a really common strategy called démembrement, basically split ownership. Parents would gift the bare ownership of the bricks and mortar to their kids to save on French tax. But the parents would keep the usufruct, meaning the legal right to use, rent, and live in the property until they die. Time for a massive professional tip. If you retain that French usufruct so you can keep enjoying your holiday home, you trigger the UK's Gift with Reservation of Benefit, or GROB rules. HMRC does not care about French civil law concepts. They look at this and see a trust. Because you're still using the house, you've reserved a benefit. So at death, HMRC yanks the full open market value of that property right back into your UK estate. Let's do the maths on this GORB trap because it is genuinely terrifying. In France, when the parent dies, the usufruct just vanishes. The kids get full title, completely tax-free, 0%. Fantastic, right? Well, no, because France charged you 0 tax on death, the UK gives you exactly £0 in treaty credits. HMRC then slaps your estate with a 40% UK IHT bill on the total market value, total double taxation, catastrophic wealth loss. So what about those offshore SPVs? Can you just hide behind a Guernsey company? No way. Parking a French villa in an SPV is completely broken now. They get caught by a nasty mismatch under the 1963 Anglo-French Treaty. Plus, you get hit with a 17% UK corporate stamp duty land tax. Oh, and a 3% French annual tax on the property's value. And to top it all off, you're usually denied unilateral tax relief. The offshore shield is dead. And if you hold UK residential property in one of those corporate envelopes, you're also facing the annual tax on enveloped dwellings, or ATDE. Look at these annual charges coming in 2026. If your property sits between £2 and £5 million, you are paying £32,200 every single year just for the privilege of keeping it in that structure. It's madness to just leave these legacy setups running unchecked. Okay, deep breath. Section 4, compliance steps required. We've talked a lot about the trapdoors, so let's build your ladder out. Here is your exact game plan. Step 1. Meticulously review your 10-year residency timeline. Are you officially an LTR? Are you in the tail? Step 2. Audit every single legacy SCI and offshore SPV you have immediately. Step 3. If you've got a usufruct triggering those awful GROB rules, you need to look at terminating it or buying it out before the taxman knocks. And Step 4. Secure compliant debt financing to help legally reduce the taxable value of the estate. But I have one last professional tip for you on this. Debt structuring is unbelievably nuanced. A French bank might let you deduct a loan against the property's value for all sorts of reasons, but UK rules are extremely strict. HMRC only allows deductions for loans used specifically to acquire, maintain, or improve that exact property. If you try to slap a random artificial mortgage on it just to lower your IHT bill, HMRC will throw it out. You absolutely need a pro for this. Which brings us to Section 5, Summary and Next Steps. The rules are harsh, for sure, but proactive planning really can save your entire global estate. Listen, do not try to DIY this. Contact Pro Tax Accountant right away for bespoke advice tailored to your exact life. Grab a pen. You can call them on 07985 689912. That's 07985 689912. Or drop an email to info@protaxaccountant.co.uk. You can also visit them at www.protaxaccountant.co.uk. And hey, make sure you subscribe to the PTA YouTube channel for lots more essential tax insights. So I leave you with this question. Is your global estate truly protected from the 2026 tax trapdoor? Or is it time to secure your family's legacy today? Thanks so much for joining us for this explainer. Now, a quick, strict legal disclaimer. This explainer is for informational purposes only and absolutely does not constitute legal or financial advice. Always consult a qualified professional before making any tax decisions. Have a brilliant day and happy planning.